Welcome to Subramani. So I would be doing 3-4 queries in one shot instead of one query in each video. Kedar D wants to know, I'm a retired person with allocation of assets as 30% equity, 30% real estate and 40% in debt funds. I mean, when he says debt. In debt, what are the options one needs to try apart from FD to get maximum returns? One good thing to do with the debt is you could put into debt mutual funds, especially now that I'm recording this in say December 2023. It's a good time to be putting into longer term debt funds. Understand that whenever you withdraw you will pay tax, but at least it is postponable. So you're a retired person, maybe going forward with inflation, if the tax limits go up, you may be able to withdraw more. So keep money in a debt fund, withdraw as and when you need, and that time you can pay the tax. So let's say, secondly, you have just said you're a retired person. I do not know whether you're 61 and retired or 91 and retired. So depending on that, a lot of these questions can be answered only with lot more details. But here is the quick answer. Stay on in debt funds, withdraw when your income is lower, or withdraw when you have some capital loss somewhere else, and then you can claim a set off. Thank you. Yeah, what other options you have? You have mutual funds, you have annuities. Those are the other options other than bank fixed deposit. Can somebody build saving by sticking only to SIP in mutual funds, predominantly Nifty index, and staying away from direct stocks? Asking somebody in the early 30s. Yes, of course you can. You don't need to invest in direct equity, except maybe some ESOPs if you get in your company. But yeah, just staying in an index fund will work, where you don't have to worry on a day-to-day basis what is happening with your money. You can even put into other actively managed funds depending on real estate, international real estate. There is no way of you can do directly, or international debt funds or international equities. You're much better off with mutual funds. Yes, so the answer is yes. If one already has a health policy, Pawan Musale wants to know, if you have a health policy and during annual checkup, if some parameter is not normal, example increase in cholesterol, and doctor starts medication, is it required to inform the insurer based on, as there is no claim at such instance? Answer is no. When I give an insurance policy to you, I am giving you a policy based on your health on that day. On that day, I do some health checkup if you're above 40 or below. If you're below 40, I just take a declaration from you saying that you're fine. So after 4-5 years, if there is any claim, you're not duty bound to come and tell me, oh, I'm having this cholesterol problem. On the day of taking the policy, if you had, you have to tell me, and it has to come out, or it will come out in a test for a person who is older. That is your duty. But do you have to inform? The answer is no, you don't have to inform. Will you have to inform if you increase the risk coverage? Say you're 40 and you feel now you should increase the risk coverage from 3 lakhs to 5 lakhs or 5 lakhs to 10 lakhs, whatever. At that stage, you will have to tell them. But if you're not making any change, you don't have to tell them. It is for existing coverage, it is not necessary. So how much of your net worth should be in your house and the one in which you are going to live? Is buying part share, okay, how much it should be worth depends on your age, because if you're just 32 years of age and you have just bought a house, chances are it is 90% of your net worth, because you have taken out every bit of money from left, right, center, withdrawn from your PPF or PF or whatever you could, and put everything in the house. So chances are it will be less. But by the time you reach say 60, it could be 5% or 10% of your net worth, depending on how much your other assets have grown. Chances are over a 30-year period, your mutual fund portfolio or your equity portfolio would have grown much faster, at a faster clip than perhaps your real estate. So obviously then the percentage will fall. But each person has to answer this for himself or herself, right? So is buying a part share in a commercial property a good way to earn passive income? I don't know, but looking after property is much more difficult than looking after a mutual fund portfolio. You just get your NSDL statement, you look at it and say buy. Whereas for real estate, you will have to go around and finding a tenant may not be available for a few months. So there are a lot of hassles about looking after a commercial property. Another thing is, when you buy jointly with somebody, you again run the risk that when that person needs money, you may have to sell it maybe at a distress, or you may have to buy him off or buy her off. All those hassles of looking after real estate is not there in equities or equity mutual funds. So take your pick. Will you get a higher return? I am very skeptical about it. But yes, as part of your asset allocation, if you think some portion should be in commercial real estate, so be it, but understand that it requires far more active management than other assets. Hypothetically speaking, if one invests equally 20% in each stock, in the recently ignored stocks like HDFC Bank, Bajaj, Kotak Bank, HDFC Life and TCS, what are the chances that he or she may lose money if they hold for the next 5 years? I think first of all, it's a hypothetical question, Saraswati, and this is so extremely biased favoring financial services, right? 80% of what you have said is financial services, and one is TCS. The next one is TCS, which caters to the financial services in a big way. So this is not a well balanced portfolio. I wouldn't suggest this. I would suggest indexing if you don't know what to pick. If you think you know what to pick, build your own portfolio. But this to me is a bad portfolio, in the sense that, and the question is, how will I lose in the next 5 years? I would not answer such a question simply because it's a hypothetical question, and secondly, I buy to earn money, not to lose, kind of a thing. So it's a very negative kind of a question, but really I don't have an answer for this. Suppose you're 25 years of age and have a lot of money. What will be the 5 stocks which you will buy for the next 10 years? It's very difficult to take 10-year views on companies, so largely you take 3-year views. Like say, if I buy Bharti Airtel, does it mean I will stick with Bharti Airtel for the next 10 years? Extremely doubtful. Maybe next 3 years I will be with Bharti Airtel. By the time maybe Vodafone will come up, maybe Jio would have established a bigger lead, so I may then go to say Jio Telecom, assuming it is listed by then. So it's very difficult to give 10-year views on any share, though I've held shares for as long as 67 years and 44 years and things like that. So I would not even know how to answer this question, but if you are not a person who is going to be actively involved, I would suggest Nifty, Nifty Next or BSE Sensex or some other good mutual funds rather than individual scripts for a 5-year, 10-year kind of a view. Do you exercise regularly? How do you keep yourself motivated? I exercise reasonably regularly, but while making this statement, I have to admit that last 10 days I have not been to the gym for whatever reasons, right? So it happens, but motivation for something like this has to be coming from inside you. I don't think you can read books or watch videos and get motivated to join a gym or go to a gym regularly. I really don't have an answer for that. What if we discard Sabari 1000 wants to know what if we discard all obvious bad stocks and buy rest of all stocks post IPO with 10 numbers with meaningful valuations and keep it forever? This is such a subjective question. Meaningful valuations, why 10 stocks? Post IPO you will buy, so that's difficult. And so 100 shares of Wipro are worth 1000 crores today. So what would be a good strategy to buy? Look, we are all talking about Wipro in retrospect, and I have made many videos on Wipro. The question is why nobody made money. Why I wouldn't have made money even if I had bought 100 shares in 1980 and I had 10,000 rupees. It's not as though I did not have 10,000 rupees. I had 10,000 rupees. I could have bought. The question is not whether you could have bought and made money. The question is, would you have stayed on for the whole journey, or would you have sold partially? Even if you had sold partially and you have 300 crores today, it's not a bad thing. But the question is, that can happen only if the other parts of your portfolio are also doing well. Otherwise, if one is doing well and others are not doing well, there's a huge temptation to rebalance. So some of this would have happened. So this is too much of theory. If you don't know what shares to buy for the future, buy the index. That way you're buying everything. What do you think of approaching good quality stocks at rich valuations? I really don't know what is rich valuation, because if you're looking at in 2023, if you're trying to buy for 2033, you don't know whether those valuations are rich. But if you buy today for 2024 or 2025, the valuations could be rich. So the question is, are you able to see 5 years, 10 years in advance, which is very difficult? or you're saying, okay, I think 10 years this company is good, but I will review it every year or two, so you buy some share. Then if it is if you think it is fully priced, overpriced, whatever, then you will have to wait for the right valuation to happen, right? That's what Buffett teaches you. Very, very long periods of sitting tight without doing anything with your money is very important for making money, but it's not going to be very easy. It's easier said than done. Thank you.